Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. Well, it's late afternoon, Friday, January 23rd, 2015, and in a special audio blog, the title is Hold Your Nose, We're Going Down. Now, it's hard to believe that my first audio blog was in September 2013, 16 long months ago. Over that time, I've learned just how powerful the audio medium can be, particularly when supplemented by my and Bill Holter's daily articles. In fact, its acceptance has become so strong, I vowed to use it more in 2015. For webinars like the Miles Franklin All-Star Silver webinar panel conducted in October, to interviews like my Brink Storage discussion with Miles Franklin's president, Andy Scheckman, to my weekly commentaries, I anticipate using audio significantly more. With each passing day, the struggle to get everything done is more difficult in our lives, which is why, care of mobile listening devices, people would rather hear what's going on than read it. Moreover, as the world careens headlong into the political, economic, and financial Armageddon I have predicted for years, I'm finding it more and more difficult to address the exploding volume of horrible headlines requiring discussion via the printed page. And thus, in such desperate, terrifying times as this, I'm finding audio blogs to be superior communication methods. So you know how committed I am to protecting you. Keep in mind that I theoretically have Fridays off, but cannot recall one in which I did not write. I was up at 2 a.m. this morning, without an alarm clock, to write the most ominous quote of the year. And here at 3 p.m., with Diana and Sylvie napping, I felt it necessary to dictate my thoughts on an historic end to an historic week. And this before Sunday's Greek elections, let alone Wednesday's FOMC meeting, both of which have the potential to be history-altering events. Watching today's markets, in the second trading day since the ECB shocked the world by actually carrying out the Abenomics-like whatever-it-takes lunacy Mario Draghi promised 2.5 years ago, two timeless movie clips came to mind. The first, which I've utilized in several articles over the years, is from The Matrix, when Neo finally realizes he is more powerful than a whole army of Mr. Smiths, and subsequently starts to brush off their most vicious attacks like they weren't there. After 13 years of fighting the cartel tooth and nail, and for the most part losing, I'm starting to feel a sense of invincibility that no doubt countless thousands are experiencing too. Not those who own mining shares, ETFs, and other paper PM investments, mind you, but actual physical metal, which has comprised 100% of my investment portfolio since selling my last miner 3.5 years ago. To that end, this week's COMEX COT report, depicting a continuation, or more accurately, explosive acceleration of the cartel's utterly desperate naked shorting of paper PM contracts, nearly made me laugh out loud. Over 13 years, I've watched them do this month after month after month, inevitably winning out when paper buyers' limited funds run out, as they always do against the deep-pocketed, unregulated government. Yes, the government, which is exactly who JP Morgan's partner is. Long ago, I wrote of how the COTs no longer matter, given that nowadays the cartel attacks 24/7, no matter how long or short they are. However, I still watch the COTs to see what they're doing, and watching them exponentially increase their shorting as both metals explode, particularly in other currencies, it made me realize that not only are they failing miserably, but that the entire world knows it. Sure, they've been able to hold prices in check thus far. However, with physical demand exploding, with nowhere to go but straight up, and supply on the verge of imploding, it's only a matter of time before the COMEX, LBMA, GLD, and all other manipulative paper vehicles are destroyed. Right now, all they have left is their paper PM suppression and stock market support. But with economic Mother Nature angrily taking back all her other territory, it couldn't be more obvious just how close we are to the death of fiat currency and the reemergence of the only real money the world has ever known. The past 2 days' markets depicted pure, unadulterated carnage, which ominously was due principally to Draghi's lunatic QE announcement. Sure, European stock and sovereign bond markets exploded higher, as like Abenomics, the central bank has essentially promised open-ended buying ad infinitum. However, Outside the 1% owning significant positions in common stocks, the 99%, rapidly becoming the 99.9%, were devastated in more ways than I can count. And this in just 2 trading days. Watching commodities, currencies, and crude oil crash more violently than ever before after the ECB's announcement, which frankly I didn't think possible, let alone just 1 week after the Swiss National Bank proved central banks are lying, thieving, clueless morons, brought to mind a second, far scarier movie scene in Lucasfilm Skywalker Sound and Dolby Stereo combined, i.e., the unsinkable Titanic plunging nose down into the Atlantic. And not the initial descent when the stern bobbed around like a cork for a few minutes. No, those few minutes were 2009 to 14, which one day will be remembered as the good old days when the global economy plunged, but the system was kept afloat by historic levels of overt and covert money printing and market manipulation. And of course, relentless propaganda that would make Joseph Goebbels blush. I wrote 3.5 months ago that 2008 is back, but since then the world has sunk far lower, and thus I have essentially zero doubt that what is occurring now is the end game of global economic collapse, currency implosion, and exploding social unrest and geopolitical tension. Just as Ben Bernanke arrived on the scene to erase Alan Greenspan's memory, and Janet Yellen to erase Bernanke's, or for that matter, Barack Obama to erase George W. Bush's, Thomas Jordan's Swiss National Bank actually managed to upstage Abenomics and the Draghi ECB to upstage the Swiss bank in seeking the grand title of the most insanely stupid, credibility-destroying, poverty-creating central bank in history. Even I am in awe of the lunacy the ECB portrayed in its actions, which, as you are well aware, appeared impossible due to supposedly unflappable German resistance. Of course, as I've noted on countless occasions, the Germans can talk as tough as they want, but in the end, they are the largest direct and indirect creditor of the pigs, with a heavily undercapitalized banking system. Thus, the ECB's maniacal 1.1 trillion euro QE program was shoved down Europe's throats like the moth pupa in Silence of the Lambs, exposing to the entire world just how desperate it was. Which is no different, by the way, than Janet Yellen pretending the oil crash is transitory and rate hikes imminent as the U.S. economy plunges into the abyss, with 30-year bond yields at record low levels as the entire world front-runs the QE into infinity that stalks every moment of her existence, just as Tick-Tock the crocodile stalks Captain Hook. When I say this is it, I cannot be more serious. I have never been one for predictions, and although this one may seem ambiguous, I'm clearly communicating my belief that the ship is going down now, and doing so at breakneck pace, with no hope of even a temporary respite. In my view, any and every manipulative tool has been milked for all they were worth, leaving the world far worse for the effort and unable to return to the surface for breath. I don't care if the BEA reports 10% fourth quarter GDP growth next week and 500,000 jobs in the January NFP report, whilst goosing the Dow 2,000 points and smashing gold $200. Any such attempts will immediately backfire, followed by far more dramatic market implosions and physical precious metal buying. And frankly, I don't even think they could get away with such BS anyway, as irrefutably the US and global economy is plunging so fast it's nearly at the point that publishing positive job numbers or GDP data of any kind will be laughed off, as no matter what deflator one utilizes or how many fraudulent business activities are considered growth, there can be little doubt that the US economy is collapsing as rapidly as those in Europe, Asia, and the rest of the world. Just look at the utterly horrifying earnings miss and outlook reduction by United Parcel Service today, if you want to know how the U.S. retail sector is doing, or the massive layoffs announced by businesses as diverse as eBay, American Express, Baker Hughes, Halliburton, Schlumberger, Cisco, Microsoft, and oh yeah, Wall Street. Just wait until after the oil crash, as depicted by today's rig count plunge to its lowest level in 5 years, is fully reflected in global E&P headcounts. Or for that matter, when the smoke clears on this year's horrifying holiday spending season, yielding the retail Armageddon that was one of my top 2015 predictions. To get a glimpse of just how badly the global economy is, take a look at what one of its supposedly strongest nations, Brazil, announced today. Brazil, despite the massive corruption, malinvestment, and inflation plaguing its society, has for years been lauded as one of the BRIC nations likely to lead a golden economic age. As it turns out, its economy is beyond depression levels, having just reported a whopping 555,000 job plunge in December alone, which based on the nation's size is equivalent to nearly 1 million jobs in the US. And heck, oil prices had just started to plunge precipitously in December, starting that month at $68 per barrel compared to $45 per barrel today. The fact that Brazil is suffering through its worst drought in decades, if not centuries, is just dramatic irony at its worst. And sadly, bad business will be far from the ugliest story of 2015, as derivatives implosions, sovereign bankruptcies, annihilated industrial complexes, collapsing currencies, draconian government policies, and widespread social unrest will result from the exportation of inflation to billions of global denizens by a handful of sociopathic, brain-dead central bankers, led by the Fed, ECB, BOJ, and yes, the PBOC in China. Sunday's Greek election is a perfect example of the carnage 4 decades of unfettered money printing, market manipulation, and financial engineering has engendered. And reading articles like the one titled Greek Syriza Victory Could Rally Anti-Austerity Groups in Ireland, Italy, and Spain, it couldn't be clearer just how rapidly things are likely to collapse. As of this afternoon, support for the anti-austerity Syriza party, or as I like to call them, the anti-Euro and pro-default party, has surged so powerfully it is entirely possible it will not only be the majority party in Greece Monday morning, but hold an actual parliamentary majority. I'm not sure how emphatic I can be about its leader, Alexis Tsipras, his desire to write off most or all of Greece's debt, as just today he claimed he, quote, won't honor commitments made by the previous government. Greece is leaving the euro currency and defaulting on its debts, as I said it would years ago, and unlike Switzerland, the impoverished Greeks cannot be implicitly threatened that their stock market will collapse if Syriza wins, as it is already destroyed beyond repair. Back to the economy, yesterday's, i.e. Thursday's, best manipulative efforts to portray the ECB's actions as successful miserably failed. The fact that oil and copper led a commodities bloodbath on the day a 1.1 trillion euro QE program was announced should tell you all you need to know, let alone the fact that the world's most widely utilized currency, which was already in all-out freefall, accelerated to Russian ruble-like implosion as a result of its central bank supposedly doing whatever it takes to save it. As noted earlier, no one could care less that PPT-supported stock markets like the Dow Jones Propaganda Average and German DAX soared, as few people own stocks anymore, and more importantly, they no longer have the slightest correlation with economic activity. More importantly, the Fed's attempt to again goose Treasury yields ahead of the FOMC meeting, in this case this coming Wednesday, was thwarted by the entire world realizing the ECB's actions were symbolic of an upcoming global QE to infinity. And more damning still, the parabolic increase in gold and silver prices in a broad swath of currencies, starting with the euro, depicted not only expectations of QE to infinity, but of all-out panic that the big one has finally arrived. Americans like myself, watching the cartel maniacally cap gold at $1,300 per ounce, 3.5 years after trading at $1,920 per ounce, may be wishing for new highs, but I assure you the majority of Japanese, Australians, Canadians, Russians, Indians, and Europeans, among countless others, witnessing all-time or nearly all-time high gold highs in their local currencies, would likely trade our experience for theirs, as irrespective of the deflation their central banks fix on, their cost of living is rising a hell of a lot faster than ours. The only reason ours has risen less rapidly is the fact that terrified global investors are fleeing to the reserve currency's liquidity. However, as highlighted in Friday's most ominous quote of the year, actually this which I wrote 12 hours ago, and countless articles over the years, such, quote, dollar strength will utterly annihilate U.S. competitiveness and corporate profits, which is exactly why Janet Yellen must initiate shortly a QE program far bigger than not only the ECB's and BOJ's, but all the previous U.S. QE programs combined. And when said Yellen reversal occurs, if you haven't already purchased your gold and silver, Good luck trying. Of course, yesterday's post-QE carnage, which was at least whitewashed by a soaring Dow, doesn't hold a candle to what we saw today, that is Friday, which in my mind may well be remembered as a catastrophic turning point in financial history, let alone if the Greeks follow through and give Alexis Tsipras an unchallenged majority on Sunday. Going back to last night, oil had given back the entirety of its $46 per barrel to $49 per barrel rally by day's end, despite the ECB's killer QE announcement, which, by the way, was notable more for the ECB governor's utter cluelessness, desperation, and lack of either tact or etiquette than the actual amounts involved. To wit, in issuing a €50 billion per month trial balloon press leak the afternoon before, but upping the actual amount to $60 billion per month the following morning, presumably because the euro didn't fall far enough for its liking, it made it painfully clear just how little analysis went into the decision, which, as you know, has been more than a year in the making. In other words, it was simply trying to maximize the psychological impact, damn the circumstances, and oh yeah, utterly destroy the euro currency. Like the Swiss National Bank last week, the entire world saw the whatever-it-takes Mario for what he truly is, a moronic bureaucrat from Goldman Sachs no less, with not a clue what's wrong or how to fix it. In other words, becoming the new poster boy for the concept of an emperor with no clothes. Anyhow, following the $60 billion per month QE announcement, the euro plunged from 1.162 beforehand to 1.138 at Thursday's close. As noted above, oil's Wednesday's completely manipulated goosing completely round-tripped, and nearly ditto for copper, which comically the Fed and friends had goosed from $2.54 per pound to $2.63 per pound in a matter of hours, as the Fed attempted its newest and most pathetic ruse of pushing stocks, interest rates, and commodities higher going into its FOMC meeting, like the all-important one this upcoming Wednesday, so as to give whirlybird Janet, quote, cushion to continue her lies about an upcoming rate hike, albeit a patient one after a considerable amount of time. It worked in December when, per my 853 points of infamy article, they managed to goose the Dow more than 1,000 points, the 10-year Treasury yield from 2.05 to 2.30, and oil more modestly from $54 a barrel to $59 a barrel, before all three plunged anew, directly following the drivel that was the FOMC statement and accompanying press conference. However, as noted above, it decidedly backfired on Thursday, meaning yesterday, despite one of the biggest QE announcements in history, and in miserable fashion, as oil had lost all its gains, copper most of them, closing at $2.59 compared to $2.63 the day before, and the 10-year yield most of its gains, falling from 1.96% before the ECB announcement to 1.89% at day's end, albeit well above the 1.77% low from the previous day. Only the Dow's PPT goose gains remained, and thankfully for them, the cartel managed to cap gold's gains to just 1.0%, keeping it right around the $1,300 per ounce level. In a future article, I'll describe how the powers that be have lost control of everything except stocks and paper PMs, the latter of which they'll unquestionably lose control of in spectacular fashion. Anyhow, as the day ended, the powers that be were obviously terrified that the QE announcement had backfired, as validated by more and more mainstream media and Wall Street firms breaking ranks by attacking the efficacy of the programs, such as Societe Generale, Deutsche Bank, the New York Times, Reuters, Bloomberg, and even CNBC. Not to mention that despite the cartel having been able to cap gold and silver's gains in dollars, they decidedly failed to prevent gold and countless other currencies from exploding higher, such as Euro gold, now just 16% from its all-time highs, Canadian and Australian gold just 10% from their respective all-time highs, and oh yeah, Japanese yen price gold, which actually closed Thursday at its all-time high. Thus, the desperate powers that be pulled out what they thought to be a trump card, just as the May 1st, 2011, when coincidentally, Osama bin Laden was supposedly killed on a Sunday night when China was closed for a holiday, just as silver was about to breach the key round number of $50 per ounce. Nevertheless, this completely immaterial event, with absolutely no relevance to silver prices, by the way, was used as cover to viciously attack silver and calm the silver fever that threatened to destroy them. Clearly, that covert op worked, so they figured they'd go back to the well via the coincidental death of King Abdullah of Saudi Arabia, just in time to rescue the oil price for the Fed meeting and perhaps boost the inflation expectations that the ECB was having so much trouble affecting. As you know, I'm the least conspiratorial person you'll meet. However, when I see such opportunistically timed announcements, especially about a Saudi figurehead whose health and death has been the subject of rumors for years, it's hard not to be skeptical. After all, Abdullah is one of America's few true allies in the Middle East, and thus a key figure in maintaining the dying petrodollar scam. I mean, this announcement literally came out within an hour of a very ugly market close for the world's most important commodity. One, I might add, that is contributing to America's collapse, like putting arsenic in the IV of a dying cancer patient. Unfortunately for the hapless U.S. government, all the announcement achieved was a brief bounce from $46 a barrel to nearly $47.50. Of course, the MSM and even Zero Hedge trumpeted oil's surge, despite it being infinitesimal in the big scheme of things. Not to mention that King Abdullah, particularly given his near invalid condition of the past 4 years, has as much impact on Saudi oil production decisions as Queen Elizabeth on North Sea production or Barack Obama on the Gulf of Mexico. Their hope was that somehow his death would be interpreted as oil bullish, based on any number of fabricated propaganda angles. However, the fact is that his death will have absolutely zero impact on oil field supply and demand, and to the contrary is a major negative for America, given that Abdullah was one of its key allies. By the morning, oil was barely clinging to $47 a barrel, and I'll get to this ignominious performance in a second. Anyhow, when I woke this morning, again, it's still Friday, even I was shocked to see the euro down another cent and a half from 1.138 at the close Thursday to roughly 1.124. The dollar index was on fire, as not only were European hyperinflation fears cropping up, not the 2% inflation type hoped for by Draghi, but true hyperinflation, but fears that the entire global economy was on the verge of collapse. Copper was down from 259 at Thursday's close to 253, having entirely erased the aforementioned pre-FOMC goosing from 253 to 264 in just 36 hours' time. Stock futures were of course higher, when aren't they, and care of the cartel's 367th 2:15 a.m. rate of the past 421 trading days, going back to the infamous April 2013 closed-door meeting between Obama and the too-big-to-fail bank CEOs, gold was, in comical fashion, back below the current line in the sand of $1,300 per ounce. And oh yeah, the 10-year yield was down from 189 Thursday night to 183, more than halfway through its inevitable round trip from the Fed's pre-ECB goosing from 177 Tuesday night to 196 Thursday morning. However, that's when the fun really started, and what will likely be remembered as one of the most infamous inflection points in financial history. As background, let's go back to the October 15th flash crash of the U.S. Treasury 10-year yield, which plunged from 217 to 187, or an astonishing 14% in just an hour's time, as global collapse fears and deadly algorithms managed to create a liquidity vacuum in the world's largest bond market, akin to the May 2010 equity flash crash, but of far larger scope and ominous implications. By day's end, the yield had recovered all its losses, but immediately I pointed out that such trading gaps are nearly always filled, which in the case of the 10-year yield occurred just 3 months later. That said, I had to do a double take when, while at the gym at 7 a.m. Eastern Time, at the 7 a.m. Eastern Time open of New York pre-market trading, the euro, i.e. the world's most widely used currency, plunged from 1.124 to 1.111 in just 10 minutes' time. It eventually ran back up to 1.127, but by day's end was all the way back to 1.120, compared to 1.138 Thursday afternoon and 1.162 Wednesday afternoon, just prior to the QE announcement. Nearly 5 months ago, I wrote of such unconscionable currency volatility as the single most precious metal bullish factor imaginable. And remember, this is the euro we're talking about, not the Russian ruble, which is why gold's subsequent capping, again at exactly $1,300 and comical raid at exactly the 10 a.m. key attack time number 1, was so transparent to the entire world. Although, as usual, the Great Zero Hedge got it dead wrong in its eternal blind spot for the pink elephant of the global monetary system. I mean, think about it. Mario Draghi claims the Eurozone has deflation because its CPI fell 0.1% for 1 month, and this with oil prices in free fall. Yet, trillions of citizens' savings have lost 20%. Trillions of citizens' savings have lost 20% of their international purchasing power in the past 4 months, and more than 1% in 10 minutes this morning. Ironically, European inflation expectations are lower at today's close than before yesterday morning's QE announcement, yet European purchasing power has plunged nearly 4% over this time. Quite the irony, wouldn't you say? Of course, what Draghi, Thomas Jordan, and the rest of the government-appointed Wall Street-funded central bankers don't tell you is that it's not consumer deflation they fear, but the financial assets that they, the 1%, own. And thus, by printing money, they become exponentially richer, whilst you, the 99%, become exponentially poorer. Which is why today alone, inflation expectations plunged despite the historic money printing announcement, with sovereign yields the world round plunging to or near record lows. In the U.S., the 10-year yield completely round-tripped the Fed's two-day pre-FOMC goosing to 1.78 by day's end from 1.96% moments before the ECB announcement, whilst even the more inflation-sensitive 30-year yield closed at an all-time low of 2.36%. In Germany, the 10-year Bund plunged from 0.44% to 0.36%. In Japan, the 10-year JGB from 0.30% to 0.22%. In Switzerland, the 10-year yield fell from negative 0.25% to negative 0.32%. And even in Greece, just days before the pro-default Syriza party may take control, the 10-year yield plunged from 8.57 to 8.17%. And no, in the case of the Greek bond, it's not because someone knows something about the election results, but instead because the market is truly taking Draghi at his word that if need be, the ECB will monetize all 400 billion euros of Greek bonds with freshly printed money, if that's what it takes to keep Greece in the Eurozone. Gee, I wonder what the euro will do under that scenario, and for that matter, euro gold, which loudly and decidedly is proving what I've said all along, as well as the laws of Mother Nature, Mother Economic Nature, and the lessons of history, and resoundingly disproving the charlatan deflationists that claim gold and silver should decline during deflation. Yes, euro price gold is surging in near Russian ruble-like fashion, up an incredible 26% since QE fever commenced 2 months ago, and 20% since the calendar turned to 2015, to within 16% of its all-time high. And for the rest of the world, as noted yesterday, yen price gold closed at an all-time high yesterday, and on average, gold is trading at no more than 20% from its respective all-time highs the world round. And since gold and silver are the world's most inelastic giffen goods, the higher prices go, the higher demand goes. Of course, the most damning proof of QE failure in yesterday's action wasn't even the currencies, or bond yields, or gold prices in my view, which in and of itself is quite the terrifying statement. No, it was the accelerated collapse of commodity prices, led by a horrifying 3% plunge in the base metals, such as Dr. Copper, down 3% to a new multi-year low of $2.49 per pound, which, by the way, represents an utterly massive downside breakout from 8-year support, portending a potential plunge to $1 to $1.50 per pound, which, by the way, would all but make the Miles Franklin Silver All-Star webinar panel's expectation of a 25 to 50% silver production plunge far more realistic, given that 2/3 of all silver production emanates as byproduct of base metal production. Remember, the two largest base metal miners in the world, BHP Billiton and Rio Tinto, nearly went bankrupt in 2008 when base metal prices plunged. And trust me, they may be back in that same position quite soon. Last but not least, oil not only plunged below the $46 per barrel close from yesterday, but at $45.29 per barrel nearly breached the $45 handle as well, adding insult to injury when none other than Treasury Secretary Jack Lew, who never comments on financial markets, dispelled the aforementioned rumors that Abdullah's death would impact Saudi oil production decisions. And by the way, why on earth did he do that? Even the Dow Jones Propaganda Average lost half its Thursday's gains, and seeing the US dollar index close at a 12-year high of 95, I can only imagine how nuclear the final currency war is about to get, as discussed in yesterday's article. Actually written at 2 a.m. today, the most ominous quote of the year. Actually, Jack Lew, yet another of Citigroup's gifts to America, although admittedly I worked there from 1998 to 2005, had a big day of putting his foot in his mouth when, following his suicidal oil comments, said the, quote, unfair foreign exchange moves initiated by the ECB will draw U.S. scrutiny. In other words, major fighting words against our so-called European allies, atop the ongoing currency manipulator accusations we make against China, which, as I wrote yesterday, they will likely rue, as when the Chinese are shortly forced to abandon their own ruinous peg with the dollar, my guess is the yuan goes down, not up, which of course will cause yuan price gold to surge, compounding already record demand, and of course utterly annihilating what's left of corporate America. And if you think speculators and sovereign banks lost a lot of money betting against the Swiss franc, just wait until you see what happens when the yuan peg is broken. As for PMs, one literally couldn't ask for a more bullish set of circumstances the past 2 days, which is exactly why yesterday's gains were capped, and as signaled by yesterday's comically obvious mining stock underperformance, the cartel attacked in prototypical form at exactly the same key attack time number 1 of 10 a.m. Eastern Standard Time, i.e. when the physical markets close, as they've done for the past 2 decades. That said, the damage was extremely minimal by day's end, and even less so in silver, which is literally screaming of an imminent shortage event. And then, of course, there's the fact that care of the surging dollar, PMs barely budged overseas and actually rose in many currencies like the euro. That said, everything I've just said pales in comparison to the day's most terrifying quote, which, truth be told, is making me reconsider the most ominous quote of the year, which incredibly was written this morning. Yes, the U.S. Commerce Secretary and per above the U.S. Treasury Secretary suggested America will aggressively retaliate in the aforementioned nuclear final currency war is terrifying indeed. However, far more so is what ECB Governor Benoit Cœur said just 30 hours after the ECB announcement, when market-based inflation expectations had already fallen below the pre-announcement level, and with them bond yields and commodity prices. As if the $50 billion per month of QE leaked Wednesday wasn't enough, or the $60 billion per month ultimately announced, Cœur said, quote, if the QE impact isn't enough, we'll have to do more, and potentially beyond the initially targeted September 2016 termination date. In other words, my friends, hold your nose, we're going down into economic hell, unprecedented global poverty, terrifying geopolitical tensions, and draconian government control. Not to mention the inevitable collapse of history's largest, most global Ponzi scheme, as central banks hyperinflate what's left of their currencies to prevent instantaneous 2008-style collapse, which, if it were to occur, despite their best hyperinflationary efforts, would be as unstoppably deflationary as the alternative would be unstoppably inflationary. Well, I was planning to finish this audio blog after Sunday night's Greek elections and market reaction. However, aside from its length, I'd prefer to let it sit on its own, given just how dire and momentous the week's events were. Of course, by the time you hear this, who knows if such events will be